Hey everybody, welcome back to Tim Travels. It's Terry, your host. So, I got my truck fixed, and it actually got fixed in the parking lot where I stopped, essentially. So I think I may have confused people with what I was saying. These weren't the U-bolts or anything like that. These two bolts that were just like vanished, like totally missing, totally gone, were the bolts for the spring hanger. So I once heard, actually when I was in training, one of our instructors said that one of the PSD trainees called the hangers the elephants, where on the Freightliners they kind of look like the shape of a face of an elephant. So that device, right, the elephant, right, the spring hanger, goes down, and it has basically a slot for the spring to come in, and and then it just bolts in there, and there's two bolts that are horizontal, right, and the nuts go on the front, the forward side. So take a look. Here's a picture of it after it got repaired. So yeah, they just came, and I had told RA, they're like, man, we're gonna have to get you towed. I'm like, once I got the trailer off my back, another driver came and repowered my load. Once I got the trailer off my back, I was like, nah, I could fix that in my driveway, right? I said, all you're gonna need is, I said a jack, but it turned out, I said a jack, a come along, two bolts, two nuts, and some wrenches, and I can fix that in my driveway. But it turned out the guy that fixed it didn't even need to take the weight off the frame. He just used a come along and basically pulled the front axle back in the line, because it was still bolted on the right side. So he just basically pulled the left side back into alignment perpendicular with the frame. Got a couple of bolts, he wrenched them, and then I drove across the street to their shop, and he put an impact wrench on it. Done. So I don't really, I've had some unfortunate things happen in Kansas, but each time the people were really nice that helped me. I don't know if I ever mentioned this, but the tow truck driver, when I had the problem with my DEF system, he was totally cool. Actually, two drivers came out. One took the trailer because they had to get repowered. The other guy brought me to the Freightliner dealership. But it turned out he has, in his previous life, used to race bicycles a lot. And so when I asked if I could bring my bicycle with me, he went way out of his way, above and beyond the call of duty, to strap my bicycle onto his wrecker, so that it wouldn't get damaged or wouldn't fall off or anything. And so, and he brought me to my hotel. So he was great. The guys today were great. One guy came, he started like aligning things, and another guy came in a pickup, and he checked what size bolt to get. He left, he came back about 5-10 minutes later, done. And like I said, I just went over there, backed into one of their bays, and he hit it with an impact wrench, and works fine, lasts a long time. So I'm grateful for that. So I was thinking about a number of things, and I'm going to talk about fire in a second. And by the way, fire is an abbreviation or acronym for, actually it's an acronym, not an abbreviation. It stands for financial independence / retire early. I'm going to talk about that in a second. But somebody in the comments to my previous video, I was talking about like the succession plan at Prime, because as you know, Prime is privately held, right? In other words, you can't buy stock in Prime, at least not on a public market. Now, maybe if you knew somebody and said, hey, I want to buy some equity in the company, you could do it that way in some kind of private transaction. So when you have a company that's privately held, sometimes those companies kind of are passed generationally to somebody's kids or maybe other relatives. But I don't know the situation with Mr. Lowe. It's not really my business. But I do know he's worked and put together a company that's pretty dang big. Has a lot of revenue. It's a multi-billion-dollar company. And so it's like, what is going to happen, right? He's a spry guy. He looks like he's in good health. He works out, I think, and hopefully he'll be around for a long time. But anybody who's at this company has to kind of wonder. And just to give you an idea, the guy that founded R&L Carriers, he passed away today. And that's like privately held company. It's not like some of the other LTL carriers that are publicly held, like Expo or Sire or whatever. So, there's always questions like, what's going to happen? Because when you have a privately held company, companies exist in perpetuity, or can. But when you have a publicly held entity, it's a little more, certainly there's more disclosure. By law, there has to be. But also, it's just, it's easier to get information, and usually a succession plan is really just, what is a board of directors that's elected by stockholders really going to do for the next, CEO or whatever. And when somebody passes away, like say Steve Jobs passing away at Apple, Apple's a publicly held company, so it didn't really matter, in a corporate governance sense, it didn't really matter if Steve Jobs passed away, because there's a board of directors. It's not like, both pilots have died and, no one's flying the plane. It's, and even stockholders could take legal action to make sure that the company isn't just, rudderless. But with a private company, that's not always the case. And some private companies, the guy that, made the secret sauce, he goes to his grave with the recipe in his head. And, it's concerning when you work for a company like that. So a comment I made to somebody was, they were, this is trucker rumor mill, so, it's basically 99% inaccurate. But, they said, well, they heard that Prime was looking to buy out Hirschbach. And I mean, if I worked at Hirschbach, it wouldn't bother me because it'd be a lot easier to spell the name of my employer. But, I said, well, I actually, and this is again from a corporate governance perspective, I would like my company, if I had to say, to be bought out or to buy out a smaller competitor that's actually already publicly held, because then what they can do is they could basically amend the articles of incorporation of that other company to immediately issue stock and allow employees to buy stock, etc. That's one backdoor way into the public markets, right? The other way is to obviously just do, an IPO if you wanted to be public. Now, why would I rather work for a public company? Because again, if I own a piece of the company, I own something that is marketable to anybody, basically anywhere, right? Like, and what I mean is, I own stock in what is called the secondary market, because the IPO is the primary market, it's called, and then any stock that's sold a second time is in the secondary market. All stock, like if you go buy a stock of IBM or General Motors or Verizon, AT&T, that's all you're buying from the secondary market. But anyway, so I mentioned that I don't like ESOPs, and that I would just prefer, like a public company. And here's the thing: when you have a privately held company, there's only 3 ways. Well, actually 4. And I'm generalizing here, but basically 4 ways that company can change hands. One is just a general succession plan where you say, okay, my ex, my favorite golf caddy, my pharmacist, my son, my daughter, my brother-in-law, my ex-wife's ex-lover, whoever, they get to take over the company, right? Like you give them the equity, so they control the board of directors, they call the shots, right? That's one way. And that happens in a lot of companies. Like, for instance, John Christner Trucking, JCT. Everybody that's anybody at that company has the last name of Christner. They might call it a family company, but it's only their family. Same thing at like Estes Express. Estes Express, anybody who's anybody at that company has the last name of Estes or is probably related to them. But other situations, like we saw with the Fry Miller deal, the owner of the company basically sold his equity, sold his ownership of the company to private equity, to a private equity group. Now, he may stick around for a while, but basically he's done. They'll get rid of him at some point when it seems convenient, and then, unless I miss my guess, they'll wring out all the value from the company and then close the doors. That's kind of how private equity rolls. The third way, though, is doing an ESOP. And I'm going to do a little, I should have got my paper out first, but I'm going to do a little, don't worry about that number, that $384, that's just what I paid a lumper. All right, so I got my Kenworth Mid-Atlantic pad, and I'm going to do a little ESOP little diagram here to show you how ESOP works. So the first person, and we'll just say, we'll call them OW, right? That's the owner of the company. And I'll just use Mr. Lowe as an example, right? He's the owner of a privately held company. He wants to basically cash his chips in. So what does he do? He sells the company. But he doesn't want to sell the company to some strangers from Los Angeles or New York or Boston who are private equity guys. He wants to sell the company and basically keep it in the hands of the people that helped make him rich. But he can't come to Terry and all these other people and say, hey, can you kick in, I don't know, $40,000 so I can cash out and go retire to Boca Chica, right? So what he has to do is he has to sell the company to an entity. And that entity, right, is the ESOP, the Employee Stock Option Program. So he sells the company, right? There's a transaction. But what happens is, in order to get the money, because the ESOP doesn't exist before they, the ESOP, I should have got my VAT board. The ESOP doesn't exist yet. So the ESOP gets formed, they get an EIN, and then they immediately say, oh, well, this entity that we formed 10 minutes ago, it's going to buy this multi-billion-dollar company. But the ESOP doesn't have any money, so what do? They borrow a butt ton of money, right, to pay the owner for his equity interest, right? So they pay him a butt ton of money. This represents a butt ton. They pay him a butt ton of money, okay? Then, as part of that deal, they also make him the CEO of the company. Not that he's not already, but he doesn't become, he only owns equity. Now, there might be a buyout, right? But then he becomes the CEO of the company. So he's a CEO, but the ESOP, The ESOP owns the company, but because of a contract, he's still the chief executive officer of the company. And he gets paid a salary or gets compensated just like the rest of us. But here's the thing, right? The ESOP for everybody else, or actually for that person too, that any money that the ESOP accrues, that's like your share value, is based on profits of the company. Well, if you know how accounting works, profit is after everything's paid for, including payments on that mega loan that the ESOP that had no revenue took out, right? And it's also payments on the CEO and all the other executives' salaries, right? So the CEO could be making like $3 million a year as an employee. That's netted out of the gross profits of the company. So the net profits, what they declare as like the profit sharing, that's after everything else is paid. So not only does the CEO get a huge chunk of money up front, huge, like the entire value of the company, but he typically gets another really nice paying job, and he's the guy, basically his actions drive what the profit looks like, drives what the employees get. And look, does it really hurt the employees? Not exactly. I mean, they do get to participate in this a little bit, but here's the thing, right? If you thought ESOPs were great for employees, then you must have also thought that employees originally came up with the idea. But no, lawyers and people on Wall Street did. Because rich owners were like, hey, I need a really good way to like make sure that my employees don't lose their jobs, but I want to get rich in the bargain. And that's when the ESOP was invented. I'm simplifying this, right? So what it does is it's better than private equity, but it's still kind of a sham. And some companies, like when I was at J&R Shugu, they have really long vesting periods, and it's totally discretionary. I'll tell you, the people who make out like bandits when trucking companies do ESOPs are all the people that have been around that CEO for years and years and years, have worked at the home office for years and years. They're the ones that really benefit, because if you have a long vesting period, and you know what turnover is like in a trucking company, it's not really going to make a difference, because a lot of people are going to come and go. They're going to make the company profit. The people that truly benefit, you either have to stick around for a long time, or you were already in the back office for years and years, right? That's kind of how ESOP works. But here's what I'm going to read a quote from an article about a company that just did an ESOP. And the company is called Rapid Response. Now, Rapid Response only has like 65 drivers, so they're not a huge player. But apparently the guy that started it wanted to buy out. He said this, he goes, "Our business is built on long-term relationships and excellent service," said Rick Palo, founder and president of Rapid Response. "I believe the ESOP transaction will only help strengthen our commitment to our customers." I have no idea why he thinks that. Employees want to keep the doors open, but they're going to continue doing what they've always done. And so anyway, I told you they have 65 drivers, they have 69 power units according to FMCSA. The new structure, which went into effect at the end of the year, means the company is now 100% owned by employees. But keep this in mind, you have no voting rights, so it's not like real stock. You control nothing, right? And in order to be part of the ESOP, like when you get hired there or while you're there, you basically sign over all rights. That's how you get to participate, is you give up any control. So it's like owned by employees, but not controlled by employees, it's like saying I own a car, but everybody else has the keys to it and I don't get to drive it myself. I have to ask permission if I want to get a ride. That's what we're talking about. But here's a great quote from this company, weirdly but maybe aptly named Butcher Joseph. They were like the advisor on this transaction, so they got paid a hefty fee. And this is a quote: "Through a leveraged ESOP sale, we provided liquidity to the seller as well as an opportunity for employees to participate in the future growth of the company," said Alberto Del Pilar, managing director at Butcher Joseph's. So let me translate that for those of you who don't speak finance guy. Leveraged ESOP sale means we borrowed a shit ton of money and the ESOP was forced to buy the company at whatever the price was said to be in the sale. So we larded up the ESOP with debt that now has to be serviced by the company, which will reduce its profit. And then there's an opportunity for employees to participate. It's not a guarantee. So we borrowed a ton of money, the ESOP did, that is, and we provided liquidity to the seller. That's another way of saying we gave a shit ton of cash to the guy that owns the company, right? And we made it sound like we were hooking the employees up. Now here's the thing, remember that finance speak, remember I told you about the revolver for ongoing operations at US Express? I know I promised not to talk about it. And remember I told you revolver is code for a line of credit? You know, same finance speak. So anyway, that's that. Now let's talk about FIRE real quick. So there's this movement called FIRE, and it stands for financial independence, retiring early. But here's what I want you to think about if you've heard about this and you're like, yeah, maybe I'll try that. Okay, first of all, one of the premises is that about 70% of everything you earn gets put away, goes into savings, with this idea that you're going to retire by the age of 40, and then you're going to live on very little money. Now, I want to say that that's theoretically a good idea, but, well, actually, I shouldn't say theoretically it's a good idea. It's an idea, because I will tell you that in order to save 70% of what you make, you probably, unless you make a butt ton of money, unless you're like, unless you're like some pro quarterback that drives like a used Chevy S10 Blazer, like you're somebody that's making like 40 mil a year and you live in like a 2-bedroom townhouse that you paid $89,000 for. I mean, that's really what we're talking about, right? So saving 70% of what you make, most people in most places cannot do that, okay? I will also tell you that I suspect that anybody that's truly living the FIRE premise is probably doing it without children. In other words, not having kids. Living on only 30% of what you make is really, really tough. But let's say that you just want to get some financial, and this is really where I'm going, financial independence. Right now, I don't care how much you're making, I will tell you that the stock market is on sale, and so are interest rates. In other words, I was looking today just on, I can't even remember, some savings website, and they had a listing of CD rates, certificates of deposit, which, by the way, if you get them from an FDIC insured bank, then those CDs are insured, right? Even if the bank fails. So now if you get CDs from a brokerage firm, those are not, those are securities. There is a difference, even though they kind of function the same. But CD rates, you can get a 1-year CD that, you know, and some of these, the minimum is like $2,000 or $1,500, but some of these CDs are at like over 5%. So let's say that you had, I don't know, let's say $5,000 in savings for emergencies. And you say, well, I can't tie up, Terry, I can't tie up my $5,000 in a CD because if I take it out early, there'll be a penalty. And you're right, there will be a penalty. You won't get the interest you were promised, right? You won't get any interest, probably. Although some are variable, some are, more malleable. But here's what you do, right? Let's say you did have the 5,000, but this could work with any number, as long as you meet the minimums of the CD. Get 3 CDs, right? So I saw one, it paid a little over 5% interest. Minimum was $1,500. So you know what I would do? I would get one CD for $2,000, one for $1,500, the other for $1,500. That adds up to $3,000. Then if my transmission craps the bed and I need like $1,000, cash in one of them. Okay, so I paid the penalty on that. But isn't that better than the money's still safe? You just weren't getting like 1% interest on it. You took a risk, maybe that didn't pay off. But if they all pay off, then you got 5% on your $5,000, right? You made $250, I think that's about it, in a year. Okay, it's better than the savings rate. But the other thing I was going to say is there's a lot of stocks that are on sale. People are fearing a recession. In a recession, bond funds will actually do better because there'll be this flight to quality. One good way to have a bond portfolio is with whole life insurance. Not saying it's the only way, but it's a good way, especially if you don't have a good life insurance policy that you own. But the other thing that's right now on sale is, and I'm going to share with you one of my picks, one of my stock picks. I'm not advising you buy this stock. I'm advising you to do your homework, but I want to illustrate a point. Verizon, ticker symbol's VZ. I think today Verizon closed around $37, $38, right? Historically, it's been well above that, but it's been kind of beaten down in part because they've spent so much money on 5G. But here's the thing, right now Verizon's dividend, their annual dividend is right around 7%. Now, if their stock price drops a little bit, the dividend actually goes up. Because if you think about it, right, the dividend is a set dollar amount that they will pay per share. But if the share price drops, then the dividend percentage goes up. But what that means is you can still get the exact same dollar amount by buying the stock. You just bought the stock for less. So you get a higher dividend, right, as a percentage of the stock price. Great opportunity. I'm not telling you to buy it. I'm not doing some pump and dump here. I'm just telling you what I've decided to do is start putting money into Verizon because I think it's underpriced. I know from reading up on them that their CapEx is going to continue to drop over the next few years because, as I said, they've fronted so much money to roll out 5G. They also have a lot of cross marketing they do. I'm not actually a Verizon subscriber for my cell phone. I have been in the past, not anymore, but I still think they're a good company. And there are plenty of companies out there, like the Motley Fools used to say years ago, and I think it's still true, buy what you know, right? You use a company's product. If you use their product, you obviously think it's some bit better than something else that's on the market. Otherwise, why would you use it or why would you buy it? Buy their stock. If you don't like the price of oil, the price of gas, buy stock in an oil company, right? Because Chevron's paying 4.5% dividend, right? Now, and I'm not advocating for oil stocks. I'm just using that as an example. But anyway, I just wanted to share a few things. I know I took a little bit too much time on the ESOP, and maybe I shouldn't because none of us can control that. We don't own some big trucking company that's gonna go that way. But you should know up front what's going to happen if you hear that. So anyway, thanks for tuning in. yeah, we'll talk. I got a whole bunch of other stuff to talk about. I know I've been a little reticent lately, but I got a bunch of other stuff to talk about. So talk to you soon. Bye.